What is it about, you said this time is different. The buildup of leverage this time is higher because we have more lending platforms, or what's caused
Yep.
this time to be a little bit different than last time?
Yeah, the market's not as pure. It's manipulated by financialization now in a way that it wasn't back in the previous 4-year cycles, because there was no leverage in the previous 4-year cycles.
Mm.
And when you started to get the Bitcoin futures market really started to take off, BitMEX started to take off towards the end of the previous one in that 2017 into spring 2018 timeframe. And of course, that's when, by the way, Tether took off too, right? Not coincidentally. It was all related to, bringing in liquidity and traders, but it's the Wall Street crowd that came in, right? Look at the background of some of the people, including some of the founders of BitMEX. These are quant traders. They looked at it in many cases, not as an asset that they wanted to own for the ethos of it, but as an asset that hadn't been financialized yet, and they could step in and financialize it. I won't name names here because I generally don't do that, but I was surprised when I read a FT article. One of the better known CEOs in this industry admitted he didn't even know what a blockchain was when he started trading crypto. It's kind of that kind of tells you something, right? It's not a shocker that some of the folks who came in with Wall Street trading backgrounds tend to be short-term oriented. They looked at this as an asset that hadn't been financialized. What does that mean? It means it's volatile, and volatile assets mean trading profits. And so they came in with the same leverage games that they'd played on Wall Street. And some of them made enormous fortunes doing that, but it is not good for our industry. That is not good for our industry. So that's what's different about the cycle this time. I like to point out that we didn't hit the blow off top like we did in the previous cycles. Each cycle has gotten lower in its magnitude. If you look on the log scale, there was a 2011, I think, blow off top. That was, and then correction that was much bigger than we saw in any of the more recent cycles. The amplitude is declining. But that said, the blow off top didn't remotely come close to what the models predicted that it would be this time. Why is that? Because the derivatives traders took the top off the market. And this gets into the mechanics of how fractional reserve Bitcoin works. That's derivatives is just one form of fractional reserve Bitcoin, the futures markets. Same thing with lending. Unless you have a lender that's a true marketplace lender that's not lending more than 100% of their Bitcoins. But I think we now know some of these big lenders, including Cred, which already filed for bankruptcy about a year ago. Some of these lenders were running fractional. You don't have any insight into whether their balance sheets whether they're even solvent, because there's no counterparty risk disclosure. The only ones that have counterparty risk disclosure are the SEC filers. And even in that case, it's not that easy to determine how they're not doing a cryptographic proof of reserves.
Right.
Kraken is doing that among the big exchanges. That's definitely noteworthy because so few are doing anything like that. Most of them are just running fractional. And if you read the fine print, you're making an unsecured loan of your Bitcoin to them. And if they go bankrupt, you become an unsecured creditor.
Right.
And you're in the pool with everybody else.
Right.
Including, by the way, with all the other stuff they have with the dicey blockchains that, may or may not actually work. And so if your exchange or your custodian loses money in one of those because they go down, and then the exchange goes down, you may have had nothing but Bitcoin deposited on that exchange or at that custodian, but you may still get stuck with losses from some, blockchain that gets 0-day exploited, that you didn't have any exposure to because you're in that pool with everybody else. And that's the way these things work. And boy, again, I wish everybody could have a cheap Gox lesson because it was cheap tuition. Not because I want them to lose money, but because of the lesson to take away from it.
Yeah. I often say that pain is information. People tend to learn the hard way. And it's true. The school of hard knocks is a real thing.
Yep.
And this.
Absolutely.
So do you think then this idea of, you said financialization, but then you said that traders took the top off of this market. So you also said you believed in cycles still. So does this mean you thought 69K was the kind of an artificial top on this cycle because of the financialization or leverage sort of scalped it from going any higher?
It is an artificial top. Yeah, it should have gone a lot higher. I'll put some cards on the table. I believe the stock to flow model works. The challenge is it's not the only thing that works, right? So you have multiple things that influence at the same time. And I think some of the critiques of folks like Nick Carter of the stock to flow model are valid. It only talks about supply. It doesn't talk about demand. So there are multiple factors, right? COVID is one of those things that's just an external thing that nobody could predict. The precise timing of course, a lot of people did predict that we were overdue for a pandemic, but so these models are never precise, right? And you can get what's called a regime shifting change in statistics phrases, where the model stops working. You might have had a brilliant model that works great, and then all of a sudden the regime shifts and it stops working. But I do believe the stock to flow model is valid in terms of one way to look at it, precisely because Bitcoin's a commodity. And it's got a lot of the same features of traditional physical commodities like metals and agricultural commodities. The stock to flow is how commodities are valued. And it's very driven by, in most cases, supply. But what you also see in the Bitcoin world, like the Bitcoin miners are behaving not too differently than the gold miners. They're basically higher volatility, higher beta versions of the underlying. And so when you catch those at the right part of the cycle, and there are a lot of very smart investors who play the commodity, just the mining firms based on the mining cycle, you want to catch it as the price is going up right after they've made their CapEx commitments. And so they start to get a high return on capital. But the timing of those cycles is really, really important to catch, because those miners, just like there's leverage to the cycle on the upside, there's leverage to the cycle on the downside. And if you look at the Bitcoin miners that are publicly traded, boy, they did they did foretell what was coming in terms of the correction in the Bitcoin price. The miners definitely led Bitcoin down. Bitcoin led the rest of the crypto industry down, and then the rest of the crypto industry has led tech down. We're just a high beta, high risk part of the tech universe for sure. But to get back to your question, yes, because the derivatives players were there, I do believe the stock to flow model had, it certainly implied that the price should have hit somewhere around six figures in this previous cycle, and it didn't. So why didn't it? Because there is a lot of paper Bitcoin out there that's supplying the real demand with fake supply. And what I mean by that paper Bitcoin is those are IOUs. If you added up all the IOUs from the intermediaries and then added up the total number of Bitcoin outstanding, it's 19.1 million or so. I don't think we've hit 19.2 million yet. I'll bet you that we already know, right? Because we've seen some failures, counterparty failures. We already know that the total number of Bitcoins promised to people through intermediaries is far greater than 19.1 million.
Right.
And so what happened? All those intermediaries that sold their customers an IOU on Bitcoin, the proverbial paper Bitcoin, that went to satisfy real demand. And anytime you push the supply curve out, if you think about supply demand, I did a tweet storm about this a little while ago, and someone just brought it up to me recently. So I can dig it up and send it to you so you can send it out. Anytime you push the supply curve out, leaving everything else constant, leaving your demand constant, what happens? Your price goes down. And that's what's happened here. There's this artificial supply of Bitcoin from people who are buying it through intermediaries in IOU form and thinking they have the real thing. And instead of having the real thing, of course they don't. They have an IOU from a counterparty that might go bankrupt. But more importantly, that's actually sapping demand for the real thing, because it's more convenient to buy the fake thing. And people think that what they have with the fake thing is real. And they learn in these kind of situations when the counterparty fails, it's not necessarily, that counterparty didn't have one-for-one backing. They promised out more Bitcoin. It's musical chairs, classic game of musical chairs. When the music stops, there's not enough Bitcoin for everybody. And then you have to freeze withdrawals, which is what we saw happen last night.